Welcome to another Taking Stock episode for the week ending the 17th of October 2025. I'm Kien, Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream into your all things share market. Welcome aboard, Jace. Hope you're having a great day.
Having a great day dealing with hay fever, Kien. It's that time of the season.
Yeah, it's so windy. It's been quite windy, especially over the last couple of days in Melbourne. But as always, the information we share today is of a generic nature and doesn't take into account your personal situation. Shares are volatile and any past performance figures aren't a reliable indicator of future performance. Well, Jace, global markets, they continue to be quite volatile, especially earlier this week as renewed US and China tensions, including fresh tariff threats and China restricting rare earth exports, that reignited fears of a broader trade conflict.
Yeah, that's right, Ken. And also the uncertainty was compounded by the ongoing US government shutdown now past 10 days. And this has delayed key economic data. Investors have moved defensively, sending gold to new highs, while broader risk appetite faded as policy clarity remained rather lacking.
And even so, Jace, not everything was negative, though. In the US, the major US banks, including Morgan Stanley and Bank of America, they delivered earnings ahead of expectations, signaling some resilience in parts of the corporate sector despite those macro headwinds.
Yeah, that's right. And also the technology sector saw renewed caution as well, Ken. So that is a place to be a little bit careful about. Softer guidance from global chip makers highlighted weaker demand outside of AI, and this prompted markets to reassess how sustainable recent tech optimism and a higher volatility environment could be sustained.
Yeah, and here in Australia, though, sentiment was quite steady. After mirroring early global weakness, the market recovered as focus shifted towards domestic policy with rising unemployment at around 4.5%, increasing expectations of an upcoming RBA rate cut. And that is supporting our local market at the moment. But turning our attention to a few star stock updates for the week. First off the rank is Treasury Wine Estates, owner of Penfolds Luxury Wines. It's been quite a pivotal moment for the business. In just
Mm.
2 weeks, incoming CEO Sam Fisher, he takes over, but the turbulence has already begun. This week, Treasury withdrew their financial year 26 guidance, sending the share price sharply lower. Jace, what's driving investors' concern here?
Yeah, it is rather disappointing about that update, Ken. The main driver of the weakness is obviously luxury wine demand, and this is particularly in China and also parts of Asia as well, where economic conditions and also gifting restrictions have softened high-end wine consumption. Now, Penfolds depletions, which means the wine that's sold through to distributors to the end consumers, have fallen quite sharply. And as a result, management have felt that their prior growth targets are no longer realistic.
Yeah, quite interesting there, Jace. But is this more of a structural problem or is it just a temporary adjustment?
I think that's the question on most investors' minds, Ken, and there is a bit of an important distinction. We don't see it as a structural decline just yet. The Chinese consumer remains cautious amid a broader slowdown, but the longer appetite for premium brands like Penfolds is intact. Treasury's diversification, including Dow in the US and also its premium Australian portfolio, provides some form of balance. Having said that, the near-term earnings risk is real, and investor confidence will take time to rebuild. Earnings downgrades have continued to flow through into FY26 and are now expected to be rather negative.
Yeah, Jace, the risks are still quite elevated. I mean, Treasury Wines is also dealing with that distribution problem in the
Yeah.
US where a key partner has withdrawn, leaving around 100 million in stock sitting idle as well. Adding in the suspension of that 200 million buyback and the mention of debt covenants, and investors are understandably quite nervous here. Which brings us to the key question. It's trading at a steep discount to fair value. So does that sell-off represent opportunity?
Well, the stock looks cheap after falling 50%, but it's no longer one of those set and forget type of growth stories, Ken. If management executes its cost reset and also demand stabilizes, then there is obviously potential for a derating. Treasury is now a turnaround story, and investors need a bit of patience and also proof that Penfolds can re-accelerate in China, and also some of that US channel is fixed.
It looks like it will take some time to regain confidence in the business. But moving from wines to software, Let's revisit Bravura Solutions, a company that provides administration software to super funds, wealth managers, and insurers. Its share price fell over the week despite the business reaffirming its recently upgraded earnings guidance at its AGM. Bravura still expects modest revenue growth of around 2 to 6% on the last year's result.
The decline wasn't due to weaker performances. Rather, it followed confirmation that one of Bravura's clients plans to transition off its platform, which could remove roughly $10 million in annual revenue. While analysts had already anticipated this, it still represents around 4% of total revenue. So it is a friendly and a timely reminder for investors that client retention is obviously a genuine ongoing risk.
And importantly, though, this revenue loss won't impact their financial year 26 guidance. And most of Bravura's income remains locked in through those long-term contracts. And earnings growth is still strong this year. But after a strong rally in the share price over recent months, investors just decided to take some profits and reassess those execution risks, particularly with the CEO change coming in January and earnings exposed to currency fluctuations in the UK.
Yeah, that's right. So fundamentals remain obviously intact for now. The market reaction was more cautionary than concern. And with the AGM season well underway, please refer to our corporate calendar for insights on when companies are reporting.
In Under the Microscope this week, we're taking a deeper look at Jumbo Interactive, the operator of online lottery platforms like Oz Lotteries. After a long period of weakness, the share price has rallied over 20% following its UK acquisition of Dream Car Giveaways. Jason, what's driving this renewed interest?
Well, investors are starting to rethink Jumbo's story. Previously, it was viewed as dependent on Australian jackpot cycles, and Dream Car changes that. It gives Jumbo a fast-growing UK platform offering car and cash prize draws, which broadens the revenue source and also reduces reliance, obviously, on lottery peaks as well. And this shifts it towards more of a digital entertainment model.
Right. So now it's seen as more than just a lottery reseller. But from a financial perspective, is this acquisition significant enough to change the earnings expectations?
Yeah, it certainly has, Kien, and we sort of saw it with consensus upgrades this week. Dreamcar is forecast to lift Jumbo's FY26 earnings by around 18%. And as I said, analysts have already started to upgrade their forecasts for FY26 and 27 as well, recognizing the higher margins and also the reoccurring customer base that this acquisition brings. It also reduces Jumbo's reliance on the Lottery Corporation and gives it a strategic independence and also international scale as well.
Right. And I noticed Jumbo is also a star income stock, and dividends is the focus here, though,
Yeah.
especially with debt used to fund the deal. With dividends expected to rise significantly next year, is there a risk to Jumbo's income profile?
Yeah, that's a good question, Kien. Dividends remain stable for now, and management may review its payout ratio at the AGM. The acquisition is earnings accretive and not dilutive, which is a positive thing. Jumbo has always remained highly cash generative, and importantly, founder and CEO Mike Veverka still owns around 14% of the company. So it's very much growth with discipline and not growth at any cost.
Well, that's good news, Jace. But one final question. After the rebound, is there still an opportunity here, or has the market already priced in the good news?
The opportunity is still rather attractive, Kian, especially given the stock continues to trade well below its highs. The share price recovery reflects improved clarity and not just market exuberance. Jumbo is now at the intersection of digital entertainment, international expansion, and also high margin growth, and this is supported by some of the positive earnings revisions that we've seen throughout the week.
And now, with hard commodities, including gold, copper, and rare earth, they continue to rally. An interesting question for investors this week is how reliable are valuation metrics like PE ratios and consensus price targets when analyzing resource stocks?
Yeah, this is a pretty fair question, Ken. And with resource companies, traditional metrics like PE ratios can be rather misleading. That's because mining company profits are heavily driven by commodity cycles, which are volatile and often outside of the company's control. A miner could look cheap on a low PE, but that could simply reflect that the earnings are at the peak of the cycle.
Yeah, that's right. And consensus price targets face a similar issue. Analysts may lift targets when commodity prices are strong, then cut them sharply when cycles begin to turn. So rather than anchoring on valuation for resource stocks, investors should focus on the quality factors of a miner, such as the financial health or balance sheet strength, return on invested capital, production and cost profile, mine life, and things like free cash flow generation.
And these metrics will tell you how resilient a miner will be when commodity prices fall. In other words, can this company survive a downturn and not just thrive in an upturn?
Yeah, it's so important, Jace, the resilience of a business. So with resources, it's more about commodity cycles and those key quality metrics. Well, that's all we have time for today. And thanks, Jace, for joining us.
Thank you. And as always, feel free to join us for Lincoln Live sessions on Monday if you have any further questions from today's episode.
And also, before we wrap up, just a quick reminder, if you have friends or family who could benefit from Stock Doctor, feel free to share our link with them. Our growth comes from our members like you, and we truly appreciate your ongoing support. Until next time, take care and have a happy, healthy, and prosperous week ahead.